Hello and welcome to the Ask About Wealth podcast. As you know, typically we bring two types of people in here to talk to me and through me to talk to you guys. The first type of person we generally bring is an entrepreneur who maybe has a few stories to tell, can tell us some of the mistakes they've made so we don't make them ourselves. And indeed for budding entrepreneurs, perhaps how the genesis story of how they got started in the first place. The second type of people we generally bring are those who work in the financial industry. But as I've described, work in the financial industry a bit in the shadows. And I don't mean that they're in the shadows in the sense of they should be in the shadows. I mean it in the sense that they're not high street brands. And I've long suggested to the high earners of Ireland that are our clientele that the high street is built for Mr. Average. And Mr. Average is well catered for in the high street. But most of the people I deal with aren't Mr. Average and therefore are not catered for. The super rich, are resident on yachts in Bermuda and pay no tax in any jurisdiction, and they're well catered for by the high end of the international tax consultancy market. But that's out of reach of most people from a fee point of view. There is a market that exists in the middle, but as I say, not as well known as the high street. And today I'm delighted to welcome back for, I think, your third visit now, Aidan, is the Group MD of ITC, Aidan McLoughlin. Aidan, thanks for joining us again today.
Thanks for having me, Paul. Great to be back.
Well, I think I predicted the last time you were here, Aidan, that we were bound to get a load of questions after our last conversation. And we'd probably have to ask you back to ask you those questions. And here you are. So, that's about as clairvoyant as I get. But particularly today, I'd like to bring up with you a number of issues that I'm discussing, if not every day, certainly every week with people I'm consulting with through the consult offering that we have. I told you before we started recording, about 96% of the people on our consults are SME business owners. And the average age, I think, is in around the late 40s. So broadly speaking, I'm dealing with, I'm talking to 16 clients in that category every week. And one of the things that that often raises its head is holding companies. And people being advised to set up a holding company in order to create an investment within a structure that's less taxable than holding same assets yourself. And one of the things, and it won't surprise the listeners to know this, one of the things I regularly talk about as an alternative to a holding company is a private retirement fund. And that's the area of your expertise, I know. And I would often say to people, a private retirement fund is a holding company that doesn't pay tax. How would you react to that? Do you agree with me? Would you caveat it in any way?
Well, I suppose I tend to be a technician, so I'd say technically it's not quite the same, but I understand the point you're making. Economically, they're achieving the same objective in many ways. With a holding company, the advantage you get is that you're taking the assets up from the subsidiary, a trading entity, and segregating the trading activity from the investment activity. And that's a good idea because it means that you're not leaving them at risk to the risks inherent in trading activity. So it's a positive step.
So it's a risk dilution.
It's a risk dilution. The other piece it's trying to achieve is that if you moved it all the way, if you look to take the money all the way out into your own name, you will trigger a high level of tax at up to 50%, bringing it into your own name. So it's parking that money halfway through to say, leave it there and you will have more money available for investment than if you took it all the way out. So that's a positive as well. The analogy you're drawing, though, is saying, well, look, if the focus is on investment, and you don't need this for your trading activity, then it makes much more sense to bring it all the way through into a private pension structure. And the reason for that is that a holding company, whilst better than having the money in the trading company, is still subject to tax. And in fact, investment income doesn't qualify for the 12.5% or 15% rate of tax, it pays a higher rate of tax, and it's subject to surcharge as well. So you can get into the effective rate of north of the 30%. Within a pension fund, the investments are tax exempt. They're exempt from both income tax and capital gains tax. So it allows that investment fund to accumulate to a greater amount quicker. In simple terms, the power of compounding is enhanced. If you're dealing with a net of tax, a 7% gross rate may be equivalent to 4% net. So it's the difference between getting 7% in your money versus 4% in your money. That's the advantage to it. The only pushback that I can think of with bringing it into the pension fund is that if the money is likely to be needed in a year or two,
by the trading entity,
it's not as easy to bring it back. If you're retiring, you may be able to get a lump sum out, etc. But that's the pushback. But if it is genuinely surplus cash that needs to be invested for you for the longer term, then the pension structure is the way to deal with it.
And I would have to say that the vast majority of people I've had this conversation with, it is about investment. It's not about, this is money that is surplus to the requirements of the trading entity. And therefore, what I say holds. A private pension fund, with its limits, which we'll talk about in a second, is effectively a holding company that doesn't pay tax.
Well, there's another advantage to the pension structure, which again may not be the focus of your clients because they may not necessarily be thinking about it that way. But if you assume disaster happens, we're all old enough to have lived through 2008, so we know what a financial disaster looks like. And in that circumstance, that trading company, that holding company could have disappeared and be lost, either due to the financial failure of the business itself or indeed the bankruptcy of the owner. But the pension could survive that. Pensions are the only assets specifically protected under the personal insolvency legislation. You can become bankrupt with a pension scheme and come out the other side of it still owning the pension scheme that you had beforehand.
And those pension schemes with a standard fund threshold today of 2 million quid, with a rising to 2.8 million quid by 2029 under the terms of last year's budget. Are you saying there that somebody could declare bankruptcy and if they were at the top of the tree from a pensions point of view could have a pension fund of 2 million quid that would be protected from that bankruptcy?
Correct. And this isn't a loophole in the legislation. This is the legislation. This is the legislation. It's specifically written into it to allow that to happen. So if you, for simple figures' sake, imagine there's a business worth 4 million at the moment, of which 2 million is in cash. If that individual ended up going bankrupt for some reason due to unfortunate circumstances, all 4 million goes down the tube. If, on the other hand, they had the wisdom to move the excess into a pension structure, then the business would go down the tubes, but the 2 million in the pension fund would survive and be available to provide for them after the bankruptcy is finished.
Okay. Every day is a school day, Aidan. It's great to hear that. Thank you. The other thing I would say to people around the comparison here between holdco and private pension is often these people are borrowing money within the holdco to buy property in particular. And I say to them, well, first of all, private pension funds can borrow money, or certainly some of them can. And the other thing I would bring their attention to is borrowing within a retirement fund is safer than any other borrowing because of this non-recourse basis. Could you tell us a little bit about that? Yes,
it's something that a lot of people aren't aware of, is that a pension fund can borrow. And typically, for example, if you're buying a residential property unit, you can borrow up to 50% of the value of it. So what non-recourse means is that the only security the bank can ask for is the property itself. So if you had, again, £1 million in your million euros in your pension fund, and you're buying a property worth 400,000, borrowing 200,000 of it, and the mathematics may make sense to do it that way. The most you can lose is the 200,000 of capital you put into it. The rest of your pension fund is protected. They cannot go after the rest of the assets on that. It's limited.
Whereas in the holding company, they can go after the rest of the holding company's assets. And in the personal debt, they can go after all your assets.
In personal debt, they can do it. And even in the holding company, there may be a requirement to provide a personal guarantee, in which case they could not only go after the company assets, they could go after your personal assets.
So you're signing away your limited liability by providing a PG in that case.
Correct. Whereas within a pension fund, again, it's not allowed for the bank to ask for a personal guarantee. So it really is just a pure investment. The bank has to decide that it's happy to lend the 50% based on the strength of the particular property asset itself.
Yeah. So within the limits that are, as we said, SFT, 2 million for now, 2.8 million by 2029, it seems to me that you're confirming what I've been already saying, which is that a private retirement fund can deliver the same benefits as, or maybe even superior benefits to a holding company, with the restriction you also mentioned, which means the money can't go back to the company. Isn't that right? We were saying about before we started recording.
Correct. And the reason it can't go back to the company is the pension fund is being ring-fenced by the state to protect it from external threats, including the business from which the money came in the first place.
Yeah.
This is the same reason why it's protected in bankruptcy. The state has actually gone to a lot of effort to ring fence that benefit to make sure it's available for you and your loved ones in retirement. That's what its purpose is, and shouldn't be knocked off course by unfortunate circumstances elsewhere in either your finances or in the economy generally.
Yeah, yeah. And before we started recording, we were mentioning borrowing, and notwithstanding you've said, it may be news to people that pension funds can borrow money. But you were also saying before, as I said, before we started recording this, that there can be reasons to accelerate the loan, to pay it off quicker within a retirement fund. Those reasons aren't necessarily mirrored within a holding company. Can you tell me what you meant by that?
So in a normal debt that you get outside of a pension fund, you have a repayment that you make to the bank, which consists of two elements. Typically, there's an interest element and there's a capital element. You're paying off a bit of the capital debt. And at the end of whatever the loan period is, you will have discharged the capital in full. But in practice, the way it works is that the capital gets paid back more and more towards the end of the loan. In a pension fund, and that works well because you're getting tax relief in the early days on the interest against the rental income. And that's fine. In a pension fund, the rent isn't taxed. So you don't need tax relief on the interest. So it pays to reduce the interest as fast as possible. If your rent generates surplus income and you're looking there and saying, okay, at the end of the year, I've the property rented, I've an extra €5,000 in the bank account, what do I do with it? You pay down the debt immediately because you're not losing anything. You're not losing a tax deduction for the interest, which would be a consideration you'd otherwise have in the holdco. So it's a different dynamic to the borrowing that you'd used to outside of a pension fund.
Yeah, and of course you're getting to keep more of the income being generated and therefore are able to accelerate the debt quicker simply because the pension fund isn't paying tax on any of that income, whereas the holding company could be paying tax on some or all of the income it's generating.
Exactly. And if you think of it in a roundabout way, let's say the interest rate on the loan was 5%. By paying off the loan, basically that excess capital is generating a return for itself at 5% because it's getting rid of a negative 5% out of the pension scheme. So whilst the typical loan term might be 15 years in a pension fund, in practice, they're often paid off faster.
Yeah. And this leads me to another point I raise with people, and especially where property investment is concerned, is that there are two returns, if you like, or two potential wealth generators in investing in property. One is the rental income that property may generate, and the other is the capital gain. But the problem with capital gain is that it tends to be locked into the property itself. And a lot of people, either through holding companies or through or through their own investments, resist claiming the capital gain because of tax. You bought a property for 200, you can sell it at 400. Yeah, but if I sell it at 400, I pay 66 grand in tax. So while there's a headline gain there, it's not real until you sell it. So a pension fund allows you to exit, to claim that gain, doesn't it? Because there is no capital gains tax.
Yeah, and it's more flexible in that regard. You're right. The motivation to sell with privately held investment property tends to be actually event driven. I've reached retirement age, or the death of the owner, or something like that prompts it. It's not market driven. It's not looking at the value is very good at the moment, and if I sell, I now can lock in the gain.
Yeah.
You don't lock in the gain until you actually sell.
Yeah.
So other than that, it's theoretical.
And without locking in that gain, the only gain is the rental income.
Well, the only crystallised gain.
The only crystallised gain, exactly. Yeah.
So the potential in a pension fund is if you looking at the market and saying, the price has gone mad, but that's what it is, but it won't be there in 5 years' time. You can make the decision now. You're not hampered by tax considerations in making that decision. So it becomes a more pure investment decision.
Yeah. Very good. Let me interrupt this podcast for a moment. Do you know how to create wealth? Do you know how to limit your taxation? Do you know how to protect that wealth when you do create it? Well, if the answer is no, our masterclass is for you. Over 12 modules and 36 videos, I will personally teach you how to create wealth, how to minimise your taxations, how to protect that wealth when you create it. Check out the link below, and now back to the podcast. You mentioned other than on debt, so let's go on. And you and I think we did a whole podcast at one stage talking about dying, so we won't do that this time. But in the spirit of what I said earlier, I want to ask you some questions, because I'm dealing with clients every day. I'm talking to people every day. And when they do have a pension scheme, they have one of two types of pension scheme, typically. They have an occupational pension scheme, where the scheme was established by the company for their benefit. Or they have a PRSA, personal retirement savings account, to which the company has contributed in the past, and certainly perhaps was contributing heavily during the January 23 to December 24, no limit. What the revenue have since called a loophole, I believe, but a loophole they built themselves for some reason, so I'm not sure how a loophole really decides it. But one of the questions I'm often asked in a consult is, what happens to my pension fund if I die? And focusing on those two, because I know there are many other different types of pension, but focusing on those two, occupational pensions and or PRSAs, let me ask you that question. What happens if I die?
It's a good question, and it is one that people don't necessarily think as much about when they're establishing the pension scheme. Obviously, the focus is on the amount that can contribute, the tax relief and the investments.
And they're going to live
done
forever.
And at that stage, living forever is pretty much guaranteed. But at some stage, if they do think about it, it's worth noting that it's not a straightforward matter. On the occupational pension scheme, where sponsored by the employer, typically on death in service, a lump sum can be paid up to 4 times salary. And then any balance in the pension fund that exceeds that has to be taken in an income format, either as an annuity or as an ARF. On the PRSA, the full value will be paid to the estate of the deceased and be distributed in accordance with their will. So if we take simple examples to follow that through, if you have an individual on 100,000 with a pension fund worth $1 million, in an occupational pension scheme, 400,000 can flow as a lump sum. And one of the advantages of the occupational scheme is it could flow directly to the spouse. It wouldn't have to go through the estate. But 600,000 would have to be used either through an ARF or an annuity to provide an income for the spouse, and will suffer income tax on that. If you assume, for simplicity's sake, a tax take of 50%, 300,000 would disappear in tax
over the drawdown period.
Over the period.
Yeah.
On the other hand, with the PRSA, if the benefit comes out, $1 million will go into the estate. If it all goes to a spouse, it's a capital sum. It's not liable to any income tax, and the spouse is exempt from CAT. So the full $1 million will accrue to the benefit of the spouse.
Okay, so to compare that with the example you've used, you've got a chap or a girl earning 100,000 a year, or one has a occupational pension scheme worth $1 million. They're both married. One has not to each other. One has a PRSA with $1 million. If they go down on the same plane, as it were, the person, the heir, the spousal heir of the one with the occupational scheme gets 400,000, 4 times their salary, plus the income from 600,000, whereas the spousal heir for the PRSA gets $1 million. Tax-free.
Correct.
Wow. So that's a 300 grand difference, isn't it, in without building growth into it?
It is. It's a significant piece. And people are building their pension benefits both for the benefit of themselves and for their nearest and dearest.
Yes.
But it's a planning point that isn't necessarily focused on enough by people in how they structure it.
And of course, the PRSA loophole, again to use the revenue vernacular on that, was shut down on the 1st of January this year. And what that means is typically, and certainly for the people I'm talking to mostly, which I said the average age is 47. So you've got, people either side of that age in terms of considerably older or a little bit younger. But it's true to say, isn't it, that these two pension schemes have different allowances. Different amounts of money can be put in. And certainly where the older generation are concerned, it's typically the occupational pension scheme has the bigger allowance.
That's right. So if you take 47 as an example, off the top of my head, on 100,000 salary, the individual might be able to have the employer company, fund 400,000 into a scheme in a single year. On the other side of the coin, with the PRSA, the most an employer could put in is 100,000 before it becomes tax inefficient to do so.
Okay.
That's the impact of the restrictions the revenue put it on, as you say, the so-called loophole that was blindingly obvious to everybody, except it appears the revenue from the outset. So that means that in accumulating the money into it, the occupational pension scheme is the better. But as we've seen in the previous example, on the death benefit piece, the PRSA is the better. So it may well be that individuals move money into their occupational scheme using the funding, and then they would have the right at subsequent stage to move money from that to a PRSA and use that as the next phase of their retirement planning.
Okay, so go back to the example you used of the £1 million in the occupational scheme. That £1 million could be moved to a PRSA.
Yes.
And then the occupational scheme could remain open, take another 400,000 in over time, assuming that was within the allowances. And in that case, if that person then dropped dead, their spouse would be getting the £1 million out of the PRSA and 4 times salary, or the 400 grand out of the occupational pension scheme. Is that right?
It's almost there.
Okay.
There's a small technicality. To get to the PRSA, you have to cease to be a member of the occupation scheme. So you stop contributing to it and the employer stops contributing.
Okay.
That triggers the entitlement to transfer to a PRSA.
Can I start a new occupational pension scheme
in
the
due
following
course,
day?
if the following year, perhaps, if that seems like
Okay.
a good idea. But at that stage, it would
Okay,
be possible to start again.
Notwithstanding my slight inaccuracy there, I suppose the message is that there's more to think about than just the amount that can go in. There's the more, the amounts that come out in certain events, and in the death event, as we're talking about here, there can be advantages to stopping your occupational pension scheme at some stage, moving that money to the PRSA, and then restarting an occupational scheme at some stage in the future. simply to benefit from the higher allowances.
Yes, obviously if somebody has accumulated £1 million in a pension fund, there's significant planning has gone into that. Some of the same level of planning needs to be put into how the benefit will come out of that. And in simplistic terms, you can argue that there's only two possibilities. Either you die or you don't.
Yeah.
You eventually die, but for benefit extraction purposes, you die before you've started to take a benefit. And that's what we've discussed there. There's various pieces of planning you need to do to how you maximise that. And then on the other side of the coin, you also need to look at that doesn't happen, and therefore you're going to be drawing down the benefit, and how you structure that to maximise the return to you on that.
I often say to people in a very simplistic way, financial planning has two issues to deal with: dying too young and living too long. And in this way, we're saying that you can and should plan for both eventualities.
Exactly. We have an office we have in Malta where people transfer benefits. There's various reasons for doing that. But one of the things that we've noted is there's about 15% of the people that have transferred it aren't sure that they need their pension for the next decade or so, even though they're at retirement age. They have investments, they have other income that has prompted them to do that. So part of their financial planning on their income has prompted them to transfer the benefit to Malta to avail of the flexibility as to how that income is accessed.
Right.
In the Irish context, once you reach your retirement date or start to take your lump sum from your scheme, you trigger the compulsory drawdown at 4 or 5%.
And that means from what you've left behind.
Yeah. That means you're taking income out of a tax-exempt environment when you might need it for your day-to-day needs. It'd be just going into a taxed investment fund outside the pension structure. So again, similar to the discussion we've just had on the death benefit, if you like, the life benefit also needs a bit of thought and planning as to where's the best place for it to be to maximise the return you get from it. There's a vast amount of work has gone into the accumulation of the money that's in the pension fund to generate, for example, profit in the business that the person owns, to be able to move it into a pension structure. But if you like, the work doesn't finish there. You also have to invest it, and you also have to be able to extract the benefit out of it in as efficient a way as possible.
Right. Well, in a way, you've kind of stolen my thunder a bit, because the third thing I did want to talk to you about was Malta. But it's a good segue into it. And I suppose the first thing I wanted to ask you about, because when I talk to people about Malta, some of them struggle with believing what I'm telling them is true. But tell me, you have a business that's focused on Malta, I know. Tell me about the history. How long has that business been around?
We're 10 years old this year, so we established the business or went live in 2015, but we were researching it for about 2 years before that.
Okay, and just because I know the history and a little bit, when you were doing this research, that's when the first challenge, isn't it, to somebody living in Ireland moving their pension elsewhere. It was the first time that somebody tried to do it, and my understanding is the incumbent industry tried to stop it. Tell us about that, if you can.
Well, I suppose if you go back to what existed before that, is that each country across Europe had its own pension structures, and they were very local. There wasn't an international dimension to them. But some of the fundamental principles of the EU is free movement of people, free movement of capital, freedom to provide services. And they go to the core of the ability to be able to have your pension structure in a country other than the one you're living in, for various reasons that can arise. We think of it here in Ireland that you might have spent time in England for a while, got your pension there, can you continue to fund it? So there's a variety of ways that can occur just naturally to the working cycle of an individual. But this was an individual just choosing to have it in Malta because at the time he didn't have faith in the Irish economy and he wanted it out of the country. That was his motivation for it. The challenge from the incumbent insurer that held the benefit was, we're not sure you can do that if you're still here. can understand you moving your pension to a different country if you've left Ireland, but you're still here and you're not exhibiting any sign of going anywhere else anytime soon, so we're not sure that's legal. So they put a stop on his transfer, and that was the challenge. It's the case is O'Sullivan versus Canada Life. So Mr. O'Sullivan challenged Canada Life on that, and it went to court.
So Mr. O'Sullivan is seeking to move his pension to Malta, and Kel Surprise, the holder of the pension here, is trying to stop him.
Correct. They felt that wasn't the principle of what the legislation was about, that it was to facilitate internationally mobile individuals, and the indication was that Mr. O'Sullivan had no intention of going anywhere. Right. He was very immobile in relation to his circumstances. So that was the challenge. The case was considered. The revenue were invited in to give evidence to the judge so that they were fully aware of the revenue requirements on it. And following that, and in agreement with the submissions from revenue, they said there is no difficulty with this. It's the same as an individual in Dublin wanting to open a bank account in Cork. You're free to move your monies to another jurisdiction if that's what you want to do. That, as you say, occurred, I think, in 2014 as we were in the process of looking at this, and it confirmed our faith that there was a long-term business here, that for various reasons people would want their money in a different jurisdiction to Ireland. Bear in mind we had been through the financial crisis at that stage, which was another motivating factor that might prompt you to want to invest elsewhere. So that persuaded us to commit the capital needed. It was £1 million to get the business up and running and off the ground in a foreign jurisdiction to a regulated standard to be able to provide that opportunity to people.
So here we are 11 years later, or nearly 11 years later. How many people have you provided that service to?
We have over 600 clients in our Malta business at the moment, of which about 30% would have taken transfers out of the Irish system.
Wow. Okay. So it's a truly international business in that sense. You're not taking Irish pension funds to Malta. You're taking pension funds from
other
all
jurisdictions
over the world.
As well. Well, yes, we have clients in 35 different countries at this stage. Now, it's true to say that the bulk of the monies in the Malta business would have been derived from pension structures either originally in Ireland or the UK, some other countries, but the vast 90% would be either Ireland or the UK.
Even though the beneficiaries of those schemes are spread across 35 different countries now.
Correct. And some of them may never have lived in Ireland or the UK, but they may have been employed by employers based in those countries.
And let's focus on the 30% of Irish people, because that's 96% of our audience at the very least. So what are the main reasons that Irish people are moving their retirement schemes to Malta?
Well, the first issue that people look at is flexibility. The Irish system, when you start to draw down your benefits, quickly kicks into a compulsory drawdown rate at 5% typically per annum. It can be 4 to 6, but averaging 5. That may be giving you income when you don't need it. An individual, particularly somebody that's owned a business, may well cease their primary income, say at 60 years of age. But it doesn't mean they cease to work completely. There are other activities they engage in, whether acting as a non-executive director, doing some consultancy or whatever, which means that they continue to have an income stream.
Rental income, perhaps.
Rental income, all that continue on. So they may not need their income immediately, but envisage in the future they will do less work and therefore will have greater need for the income then. But the Irish system forces to take them income whether they want it or not. The Malta system does not. So that flexibility is very important to people. The second thing is, again, focusing on death benefits, because we've mentioned those, is it's much more flexible on the death benefit. The individual that owns the pension can nominate who the death benefits go to, just literally list them with the percentage after their name as to who will get that. They can adjust it at any time. But if they die, we can apply the fund in its entirety to those individuals.
So they can give you specific instructions, independent of their will, independent of other things, saying, this money's in Malta. I want 50% to go to my missus. I want 20% to go to my child, or whatever it might be.
And another feature that's flexible there is it doesn't require them to be a spouse or child. It can be less formal relationships can be covered by that, where people have second or third relationships at this stage which aren't necessarily formalised into marriage, and the planning that's needed for that. So it allows them flexibility, and that's the key word to it. So they're flexible on the income, there's flexibility on the death benefit.
And do the Maltese authorities tax that distribution in any way?
The rule is that it would be taxed in Malta unless it's paid to a double tax treaty country. Now, Malta has double tax treaties with 75 countries, so the vast bulk of major jurisdictions in the world are covered. So take a simple example of somebody still resident in Ireland. If they're resident in Ireland, we will pay the income gross to their bank account. But because they're resident in Ireland and they're receiving income, they now have a tax obligation to the Irish
self-assessment obligation.
They self-assess and will pay it in October each year.
Okay. But if that's my wife, there's zero tax anyway because of the spousal exemptions.
If it's a death benefit, it's zero tax.
Okay. Very good. And okay, so that's two reasons. They've got flexibility and you've got the death benefit.
A third reason we have seen is that those that have accumulated larger funds, so if you're getting close to the 2 million threshold limit that you mentioned there, in an Irish context, if you leave it there and let it grow beyond that, you may end up with excess fund tax. So at the moment, at the 2 million, when you come to retire, it's worth 2.4 million. You have a 400,000 excess. You end up paying 160,000 in tax on that. The fund pays it out before you get it. So your fund is reduced by the 160,000.
So the money's gone.
And then you'll still pay tax on the drawdown income thereafter. You end up with an effective rate of about 70% on that portion of your fund.
Okay.
If instead you move that fund to Malta when it was short of the 2 million and it subsequently grew to be 2.4, then you wouldn't have that problem. That 160,000 is saved because the threshold test was done the day you moved it to Malta. You were below the 2 million. The subsequent amount doesn't come back into the system.
Okay. And that kind of enhances the message, which I think certainly I know we're trying to give out, which is it's all about planning in advance, isn't it? It's all about envisaging these issues long before they occur even, and saying, well, in that, what can we do now that will de-tax that event down the line?
Correct. I mean, a lot of planning has gone into creating the pension fund, filling the pension fund. Then the managing of how you deal with the benefits thereafter needs a similar amount of planning. And it's worth, like the numbers have obviously, given the size of the fund, become very significant. We saw on the death benefits that the difference between the PRSA and the occupational scheme on £1 million benefit could be a loss of 300,000.
Yeah.
In that example there, which is just me choosing random numbers, the difference between moving the benefit to Malta and not was 160,000 extra in tax. These aren't insignificant numbers.
No.
A lot of work has gone into accumulating that 160,000. It's not something to give up casually. It requires consideration and planning.
Okay. Okay, so you've got the flexibility, you've got the death benefit, you've got the no excess tax. You were saying too about there's no compulsion. So let's say I am an Irish pension fund holder who has moved the funds to Malta before, in a timely fashion, and I want to access a lump sum. What are the allowances and what tax do I pay? Now, I'm still resident in Ireland, so I'm assuming for this question I'm still here, but my pension fund's gone overseas, as it were. What are the allowances for the lump sum, and what tax would I pay on that, receiving that sum in an Irish jurisdiction? So
if you're still resident in Ireland, the lump sum from Malta will fall into the Irish lump sum tax regime, which, as you recall, allows for 200,000 as tax exempt and 20% on the next 300,000. So there's a 500,000 tax favoured amount. But the difference in the Malta regime is that the typical lump sum in Ireland is 25% of the fund. Malta allows 30%. So if you look at it in the context of a smaller fund at the moment, let's say 600,000, 30% of that is 180,000. That falls under the 200,000 limit. So you have 180,000 tax exempt, still resident in Ireland. If you were taking a lump sum out of an Irish pension fund worth 600,000, you'd get 25% of it, which is 150,000 tax exempt. So although it's the same tax that applies, because of the difference in the benefit rules,
yes,
you're actually getting 30,000 extra out of it. So that applies at the lower level.
So I would have maybe imagined that the only, excuse me, one of the reasons or predominant reasons to move to Malta was you had a huge fat pension fund. But in that example, it doesn't mean you don't have to have a pension fund at or close to the SFT, the limit, to have some advantages for moving.
So if the example I used was 600,000, you can see there's an advantage on the lump sum benefit there. You still get as well the flexibility of the deferral of the income to be able to reduce it or not take it at 4% or 5%. If you wanted just an income at 1% of the fund, that can be done.
Right.
So you still get that advantage as well. And also it would still work on the advantages on how the death benefit is distributed. So if they're set up side by side, you have the flexibility inherent in the Malta system will outweigh the benefits of an Irish system, even if you're resident in Ireland and continuing to reside in Ireland and no intention of ever leaving Ireland.
Yeah.
There are advantages there that will make sense.
And from what you said earlier, Malta will dispose or will pay out whatever the benefits are, lump sums or regular incomes, without Maltese tax interference, as long as they're being paid to a resident of a country with which Malta has a DTA, a double tax agreement. And you said there's about 75 for them. And I presume all of the EU countries are
correct.
Okay. So that, I'm aware that from time to time certain countries seek to attract overseas pensioners. And will offer those overseas pensioners considerably lower income tax rates on their overseas pensions than would be paid if that same taxpayer remained in the Irish jurisdiction. Do you see that happening in the Maltese world you're operating in, that more and more people are changing their own, not having changed their pension tax residency effectively from wherever it came from to Malta, they're also looking to change their own tax residency?
Yeah, that would be an aspiration for a good proportion of the individuals involved. Whether they exercise it or not, they certainly would have it within this is a possibility.
Yes.
They obviously need to look at their business and their family circumstances and the impact of that.
The dotting the I's and crossing the T's from, I often say to people, it isn't a matter of getting on a plane and ended up in Andorra and going, oh, you-hoo, I'm now resident over here. There's a bit more complexity to it than that.
So if you look at a jurisdiction that's been popular up till recently was Portugal. And Portugal was popular for a number of reasons. Firstly, the obvious one was it's a nice sunny climate, a bit warmer than Ireland. But also its cost of living was lower, so your euro went further. So if nothing else, and you were getting a certain amount of income every year, it actually stretched a bit further if you're operating within the Portuguese system. But also, as part of its incentive of its economy since the financial crisis, for a number of years, a decade and a half or more, Portugal operated a non-habitual residence regime, NHR. And essentially, in the latter stages of that, it allowed for a 10% tax rate on your pension income. So your pension income coming from outside of Portugal would be taxed at 10%. And therefore, that meant your income went far further than an income that's being taxed at 50%.
Absolutely.
You can think of it as you're getting 10,000 a year taxed at 10%, you've 9,000 to spend. If you're getting 10,000 a year taxed at 50%, you have 5,000 to expend. You have 4,000 extra in your pocket to cover your expenses, which are costing you less anyway in a Portuguese environment. So very popular for that reason with that. That has now changed. It's not available anymore. One of the reasons they changed it is that because of its success, it actually drove up the price of houses in Portugal, which caused problems.
The Portuguese couldn't afford the properties anymore.
Correct. So they felt the need to turn it off at that stage. But as you correctly say, there are other jurisdictions opening up, realising that yes, it caused a problem at the end, but it did drive the Portuguese economy forward in building those houses for those people, etc.
Yes.
So Greece has now come in with a 7% rate, for example, to help its economy along. So tax isn't the only reason people will go to live there, but if they're evaluating it, they can consider tax as one of the factors in what they're doing, and it can, again, enhance the benefit that they're receiving.
That's Aidan, thank you very much. You've answered my questions, hopefully given the listeners new knowledge and new information, which is the key objective of this business. And I suppose, as I've said to listeners before, Benjamin Franklin famously said, the only two things sure in life are death and taxes. And he might have been right when he said it, but he's not right anymore. Death, yes. Still, but taxes, maybe not. And the message is, isn't it, get advice. Get somebody who knows what they're talking about, has the opportunity to help you decide whether you can benefit from Malta, a pension fund instead of a holding company, planning death benefits, God forbid, there's more to it than somebody simply flogging you the product.
Absolutely. The advice is a tiny fraction of the benefits that can be generated. And it's not reasonable to expect a person that has their own business to run, their own daily work to do, to research all the points involved. It is get advice. The advice is there, and to get it, and it can be very beneficial financially for them.
Look, again, Aidan, thanks for your time today. I appreciate it. I'm sure our listeners appreciate it. And as I've said the 3 times you've been here before, it's likely that we'll get more questions. We'll have to ask you back another time. But for now, Aidan McLoughlin, Group CEO of ITC, thanks very much.
Thank you.